I'd like to introduce a longtime friend, former Deputy Governor of the Bank of Canada, and our moderator today, Paul Jenkins, who works with the Center for International Governance Innovation in Waterloo, Canada. And thank you for joining us, Paul, and inspiring this panel.
Okay, thank you, Rob, and it is indeed a pleasure to be here today. We have a very interesting panel this morning on a very important set of issues. If I may just very quickly introduce the panel, we have our two discussants surrounding the panelists. To my immediate right is John Smithin, Department of Economics and the Schulich School of Business from York University, Toronto. The far right, Professor Carmen Reinhart, the Peterson Institute of International Economics. And our panelists, I'll go from my right across. Richard Koo, Chief Economist of Nomura Research Institute. Mario Seccareccia from the Department of Economics, University of Ottawa. We have next to him Professor Duncan Foley, Leo Model Professor in the Economics Department at the New School of Social Research. And next to Professor Foley is Professor Alan Taylor, Director of the Center for the Evolution of the Global Economy, University of California. So we have an excellent panel and two discussants on a very important topic. The title of our session, Getting Back on Track, Macroeconomic Management After a Financial Crisis, can cover a very broad set of issues. And I think there are a couple of ways of trying to break that down. One would be in terms of the effectiveness of policies in response to the global financial crisis itself. The other would be the effectiveness of policies in the aftermath of the crises. Now, with regard to the former, on the one hand, of course, we have fiscal policy and the actions that were taken in November 2008 to provide some stimulus to global aggregate demand. And issues here center around, for example, the size of the fiscal multipliers. Perhaps in this context, especially given the global nature of the fiscal stimulus that was being put in place, but as well at a point in time when monetary policy was operating more or less at the effective zero bound, certainly across a number of major jurisdictions. On the monetary policy side, we of course saw the coordinated 50 basis point interest rate cut in October of 2008, really quite an unprecedented move. But then subsequently, as we got deeper into the crises, a number of key central banks moved very aggressively to put in place unconventional monetary policy. On the one hand, we have quantitative easing. We also have what I would call credit easing that had been used. And a third area, which I'm familiar with in terms of something we did at the Bank of Canada, which was to make a conditional commitment on setting the policy rate for a particular period of time to influence future rates going forward and certainly out the yield curve. Now, these are all very important issues in and of themselves, but there's also the issue in the aftermath of the crisis. To what extent, if at all, have macro policies and tools been rendered less effective? And some of the issues here would be, is there a greater risk of operating more frequently at the effective lower bound? And what might that mean? The implications of the need looking forward for certainly a number of years for balance sheet repair. And again, what might that mean in terms of the effectiveness of macro tools? We also have still very much with us a deleveraging process, and how might that also influence our thinking about macroeconomic policies? And the implication of policies and tools of political economy issues being raised around the role of the state itself. So these are all very important issues that I believe fit in one way or another into our session. But I think there are a couple of other areas that are worth reflecting on in our session today, and let me just mention a couple of those. First of all, I believe these are issues that need to be thought about as much in the international context as in the domestic context. And if there's one thing that became vividly clear during the global financial crisis is the interconnectedness, the interdependencies, the spillover effect. So when we think about macro tools, we need to increasingly think about that international dimension. Second, what in fact are the right or meaningful goals for macroeconomic policies? For example, what is the role of macroeconomic policies in promoting financial stability on the one hand, in addition to macroeconomic stability? What is the role of regulation? Generally, how has the financial crisis influenced our thinking on the question of policy assignment? And finally, how do we control our economic systems? We heard a lot yesterday about the need to handle change and uncertainty in our models. Well, what do these same issues imply when we think about the application of macroeconomic tools? So let me stop there. Our time allocation will be 15 minutes for each of our panelists, followed by 10 minutes for each discussant. That should leave us about 25 minutes for an exchange amongst ourselves, and then we will have plenty of time to open it up to the floor for questions and comments. So with that, let me turn to Professor Foley to lead off, please.
Thank you. This paper really consists of one figure, and I just wanted to tell you a little bit about the background of how I came to try to collect this data and present it in this way. When the crisis started, I was very interested in trying to get some back of the envelope, as people say, notion of how big the fall in output and in employment might be. And when I did those back of the envelope calculations using my incredibly primitive 1960s Keynesian multiplier type of analysis, I thought that output might fall in around 15 to 20%, and employment might fall by about half that amount, 8.5 or 10%. Given where unemployment started, that would put a peak unemployment between 10 and 14%. And it turned out that I was not so far off on employment, but I was very far off as far as output, at least measured output. And that began to get me interested in looking a little bit into what is going on with GDP. Larry Summers actually mentioned this problem last night, that long-standing statistical correlations between GDP measures of real output and employment are not holding up very well during this period. So what I did was to create an alternative, as simplified as I could, alternative set of national economic accounts, a national economic indicator, which excludes specifically those sectors where there is no actual value added. That, for example, government, and as a result, the Bureau of Economic Analysis imputes an output to those sectors in such a way that the value added is equal to the incomes generated in those sectors. That's in contrast to sectors like manufacturing or construction, where there is a value added directly measurable. So the sectors that are excluded are basically finance, education and health services, and professional business services and government. In order to get historically consistent series, I also had to exclude, for this particular indicator, other services, although the services of wholesale and retail trade and transportation and utilities are included. So this figure, which unfortunately is a little bit cut off on the bottom, is the horizontal axis is actually quarters starting from 2001. And the vertical axis, which is not reading properly, is an index number where the start of the time series is 100. The blue is the index number of real national income, which closely tracks real GDP. The red is my narrow measured value-added index, which excludes the sectors where the imputations take place. And the green line is employment, is an index number of employment. And as I said, if you can understand this figure, you get pretty much the force of the discussion. And let me just point out a couple of salient features of it. First of all, you can see that the 2000 recession, which was very mild by real national income or GDP and rather short measures, was much more severe and longer by the narrower measure, the value-added measure. And that would help us to understand why that was viewed as a jobless recovery. If, in fact, a better indicator of aggregate demand in the economy is the value-added sector, then it's not surprising that it took a long time for employment to recover, because, in fact, it took a long time for the economy, that part of the economy, to recover. Second, actually, the value-adding part of the economy caught up in growth terms with the national income to peak out at about 115. It was not a particularly strong recovery, but both series peak out around 115. It's interesting to see that the value-added indicator turned down much before the real national income indicator. It turned down actually in the last quarter of 2006 or the first quarter of 2007. And as you can see, the fall in the value-added indicator is much bigger than the fall in real national income. And that's due to the fact that these imputed incomes tend to cushion real GDP and real national income against cyclical fluctuations. In fact, from the value-added indicator, the fall was about 20%, pretty much what I had thought might be in the ballpark. Whereas on the real national income indicator, it was only about 10%. Both indicators show a recovery, a turnaround in the middle quarters of late quarters of 2009 and 2010. I was just able last week to get the BEA numbers for the fourth quarter of 2010, which is the last data point on this graph. And as you can see, in fact, there's a rather dramatic fall in the narrow measured value-added index and a small fall in the real national income index. That, of course, has to be taken cautiously because all of these figures are subject to revision after the first reports. So I think what we learned from this, which is important to me, is that there's a chance that from the point of view of understanding aggregate demand and employment, real GDP, because it includes these imputed sectors, is distorting our understanding of that relationship. And that distortion is not benign in the sense that not only is the gap increasing over time, but there's a strong cyclical component to that gap which is increasing over time, as you can see from this figure. In order to look into the question of the relation between these two indicators and employment, I created this figure, the missing, for some reason, horizontal axis is trillions of real dollars or billions of real dollars. The vertical axis is employment in millions of people. They're both logarithmic axes, but this is basically a scatter plot. And you can see that both the value-added measure and real national income over the post-World War II period are quite closely correlated with employment, but that correlation changes and deteriorates for real national income in the last two business cycles, which are the very top element over there. In order to look at this a little bit more, I actually plotted this fit line, which is the dashed line in blue and red here, and the most recent quarters, the last two business cycles, this is sort of a blow-up of the last thing, of the last slide. And you can see that if you had tried to estimate employment change by the narrow measured value added, you would have come fairly close. I mean, not perfectly, but pretty close. Whereas you would have made a very big systematic error if you used national income and the historical pattern of correlation. What would the economy look like, the U.S. economy look like, if we measured it by this narrower index and excluded these imputed outputs? Well, first of all, it's obviously, this is just time series, and on a log scale, plotting the real numbers. Obviously, the narrow value-added economy is smaller than when you include these imputed sectors, but it also has a lower natural growth rate or average growth rate. It's about 3.3% for real GDP or real national income and about 2.4%. And you can see rather dramatically in this plot the tendency for the narrow value-added indicator to drift quite a bit below its trend line in the last two business cycles, which suggests some structural changes in the economy that short-term policy has not been able to address. I'd just like to spend a little time on the question of which of these indicators you might be more interested in. Certainly, if you're interested in predicting employment, it looks like the value-added indicator, measurable value-added indicators are going to be much better. This is a reminder to us that national income accounting is basically a set of conventions. And there are various decisions that could be made as to which monetary transactions we include in it and which we exclude. My own personal opinion about that, I think other people mentioned this in the last couple of sessions, is that one indicator is really not going to do the job for answering all kinds of questions. So if you are trying to measure economic welfare, or even economic material welfare in some average sense, you might want a very different indicator for measuring income or measuring aggregate demand and employment or measuring the impact of the economy on the environment. On this particular point of the treatment of financial incomes, it's important to realize that both classical political economy and national income and product accounting agree that purchases and sales of existing assets do not constitute production, so those transactions are excluded from measures of national income, and the changes in the prices of existing assets do not contribute to income. The reason for doing that is that it assures that the methods will make national income measures coincide with national product measures, which was Keynes's postulate. Actually, there are other definitions of income, such as the Simons definition, which would include capital gains and losses on existing assets, but the national income accounts don't follow that convention. So we're actually dealing here with an issue that goes back a long way. The classical economists and Marx, for example, distinguish productive labor that adds value to inputs from unproductive labor that contributes to the realization of value in sales and the broader reproduction of the economic and social system. Neoclassical economics, on the other hand, centers on the generation of economic surpluses in voluntary transactions. And that includes the sales of existing assets, because if you move an existing asset from an agent who values it at a lower price to an agent who values it at a higher price, there is an economic surplus involved in that, and that's typically the kind of transaction that the financial sector is generating incomes from. While NEPA excludes capital gains and transactions in existing assets from measures of income and product, the treatment of financial transactions does include some part of these money flows in a kind of eclectic and inconsistent way that we may want to think fairly hard about. The point is that if the actual sale of an asset of an existing asset from one agent to another does not generate national income or product, but if they pay a fee to a broker or some market maker, then that fee is counted under the conventions of NEPA because that generates an income for the financial sector and therefore leads to an imputation of a financial services output in that way. Now, this also raises, I think, some more fundamental questions about political economy and the kind of wealth of nations perspective, which is what role do you want financial institutions and a financial sector to play in the broader in your broader economic development strategy? And I must say, I'm particularly concerned that many countries, including the United States, and many political leaders seem to view finance as a kind of a magical, one of those fairy tale salt mills that just keeps grinding out income without anybody having to actually put any effort out to producing anything. So you can see a couple of things. I'll just try to conclude with this slide that this way of thinking starts to imply. One is that it may be incautious to depend too much on finance and the growth of financial incomes as the basis for an economic development policy. Second, from this point of view, it looks like what the United States seems to be drifting into is a policy of moving the actual production of value to offshore sources, and then hoping that it'll get the profits back by financial manipulations or financial interventions. And I think that sounds to me like a pretty unstable path to be on. So I'll stop there.
Okay, thank you very much, Professor Foley.